Hello, everybody, and welcome to today's IMPLAN webinar, Understanding Multi-Regional Input, Output, or MRIO Analysis. If you're not familiar, I am Michael Neely. I am a Senior Education Services Specialist working on the Education Services team with IMPLAN. I've been here for a little over 3 years, and joining me today is IMPLAN's Director of Education Services, Angela Slovachek. Here at IMPLAN, we do like to keep our webinars as interactive as possible by allowing attendees to pose questions live to the presenters. However, today's presentation will likely take close to the full 45 minutes. So we ask that if you do have a question related to today's topic, please utilize the question box and go to webinar, which is shown here on the screen. We will do our best to monitor the question box throughout the presentation. If you think that you might want to ask a question, just make sure that you have your control panel open by hitting that orange arrow on the upper left-hand portion of the pop-up window. At the conclusion of today's presentation, if we have not had a chance to answer your question in our allotted time frame, we will personally follow up with everyone to make sure we all get a response. And with that, I'll go ahead and pass the mic off to Angela to take us away.
Thank you so much for the introduction, Michael. For those of you who were unable to join our webinar last month, Dr. Bjorn Markussen, IMPLAN's Academic Sales Director, presented on the power of national economic impact studies, highlighting the capabilities of IMPLAN for use in multi-regional or MRIO input-output analyses. So today we are going to cover the basics of MRIO. We're going to talk about how MRIO differs from the standard single region analysis, when it becomes appropriate or necessary to perform an MRIO analysis, and then we're going to finish out the webinar with some standard best practices and an in-app example. So before we dive headfirst into MRIO, I think it's best to first talk briefly about estimating economic effects. Most, but certainly not all of our customers come to IMPLAN looking to do an economic impact analysis. This type of study, which estimates the economic effect of an event in a specified geographic region. There are 4 components to an EIA. One is the event itself, right? We have to know what it is that's taking place. We need to know when it is taking place. We need to know where it is taking place, the region, and we are going to estimate some level of effect. Usually customers already have some type of activity or policy in question, and they need to determine or estimate its impact or effect on the wider economy. So therefore, the event is often known, and inherently, because it's an event, they know when it takes place. The economic effect is what our customers, you all, are coming to IMPLAN for, right? The IMPLAN multiplier. What are the effects of this one event? However, the 4th component, the specified geographic region, is often where people struggle. Where should my analysis take place? Great question. And the answer, of course, is always going to be, it depends. Defining the region is very important, as what you select for your study is going to determine the boundary or extent for the quantifying of spending that is going to be supported by your event. The most appropriate region for any study using IMPLAN is going to be a function of 2 variables, where the impact, event, policy, whatever it is, takes place, and where you'd like to measure the effect. Those are oftentimes at 2 different scales. There could be a business which operates in Denver, Colorado, but we need to see the impact on the entire state of Colorado. The boundary for quantifying the spending supported by that business in Denver could be Denver County itself, or it could be central Colorado, or it could be the entire state of Colorado. There is no right answer here. It is truly up to the person conducting the study, or rather who's paying for the study. While there is no right answer, there is certainly going to be a wrong answer, right? You would never use Mesa County, Colorado to estimate effects on the Denver-based business because it doesn't operate there. It doesn't make sense to do that. But when defining a region, you are by definition limiting the effects of your study to that region. Any spending that does not generate additional spending or effects in your selected region is what we refer to as a leakage in IMPLAN. Modeling in IMPLAN is going to trace all of that spending through an economy, and it's going to measure the cumulative effects of that spending. Most, but certainly not all, of our analyses will generate three possible types of effects: direct, indirect, and induced. As I said, most of our effects or most of our analyses in IMPLAN are going to generate all three. And they're typically going to start with that direct effect. The direct effect is going to be the activity or policy that you are modeling in that region. Those direct effect values are going to be applied to the industry's indirect multipliers to calculate the supply chain purchases, or those backward linkages within the regional economy that are going to support that directly impacted industries. So again, thinking about those supply chains, right? But not all of the commodities or those goods and services in our supply chain are going to be sourced locally. Some are going to be imported to the region. These are considered leakages, right? As those dollars are going to leave the region and become income to a producer in another region. IMPLAN also assumes that some of the profit and taxes that are going to be paid by this business are also going to be leaked out of the region, right? Because those dollars are, we don't know, IMPLAN doesn't know how those dollars and when those dollars are going to be respent, right? Are they going to take that profit and buy a new machine? Are they going to take that profit and pay down a loan? Where are those dollars going? How are they going to be spent? We don't know, so we don't do anything with them. They're a leakage. But when we take our direct effects multiplied times those indirect effects, that gives us our indirect effect on our local region. So the last thing is our induced effects. So the people who work in the directly impacted industry and that indirectly impacted industry in our supply chains, all of those workers are going to earn income from their participation in production. Some of those workers are also going to live in the region, while others are going to commute into our region, living somewhere else. The income that is earned by our local resident workers is considered household income. The household spending of that disposable income in the region, after we remove savings and personal taxes, those generate induced effects. Any backward linkages stemming from those households spending money in the region creates additional rounds of spending, right? Additional induced effect. Like when a household goes to a restaurant and that restaurant buys produce from a local farmer, right? Spending going round and round. The people who don't live in our region, the commuters, they go home to their region and spend their income there. That in an analysis is treated as a leakage, right? They take those earnings, they go to their region, and they spend the money there. All of these calculations that are used when we're running an analysis and IMPLAN are already baked into our social accounting matrix. It represents the economic conditions that were present in our region in that data year. Commuting, taxes, savings rates, supply and demand of goods and services, all of those are built into those multiplier calculations that are used in an IMPLAN analysis. So that's what's happening when you're running a simple analysis using a single region in IMPLAN. Now let's talk about the MRIO and how it's going to differ. So let's start at the very beginning. The first US national IO table was constructed by Vasily Leontief in 1944. However, early on in the development of that IO, there were discussions of creating sub-national models. The idea of MRIO dates back to at least 1951 when Walter Isard first conceptualized a pure interregional model starting from those regional models and then building upwards. Whereas the first disaggregated national model into component regions was suggested in an IO context by Leontief and Strout in their book Multi-Regional Input-Output Analysis in 1963. Leontief's interregional system is what we refer to as those balanced models. Everything sums up to the national. So the idea was there, we just lacked the data necessary to accomplish this. It wasn't until Karen Polensky came onto the scene that we actually had some MRIO tables. She was the first person in the US to incorporate gravity model estimations for a trade flow of commodities, which led her to construct those first MRIO tables in the US in 1970. She split the US into 44 regions and 78 industries. We would later find out that the Japanese had already done this in 1960 and 1965, but Karen was still the first one to do it in the US. Ever since, though, gravity models have been widely and effectively used to predict trade flows. IMPLAN first developed our version in 2005 in conjunction with the US Forest Service. So MRIO, or multi-regional input-output analysis, is a type of analysis which utilizes those interregional commodity trade and commuting flows to quantify the demand changes across regions that stem from a change of production in another region. When running an impact analysis, you can see how much money is leaking out of your city through trade and commuting. But of course, we live in regional ecosystems. Using the MRIO, you can see where some of that leakage ends up, supporting some of your other regions. This powerful analytical method allows you to go beyond a single study region, measuring the economic interdependence of regions. And it allows you to capture some of what have been a leakage in your traditional IO model. So those leakages in a single region analysis can be captured. Some, not all, can be captured in an MRIO analysis. So what are those leakages? There are three in particular. The first one comes from industries themselves. When industries purchase their intermediate inputs, or those goods and services that they need in order to produce their own product, thinking about something basic like a bakery, they're going to purchase flour and sugar. But what if they can't get that flour in their region? They're going to have to import it. If they happen to import it from the county next door, and we've included that in our study, we're now going to be able to track those dollars to that neighboring region. The second leakage that we're going to be able to capture is going to be the household spending of money purchasing goods and services from those other regions as well. Households earn income, they buy goods and services, but we know I don't buy all of my goods from Utah, even though I live out here in Utah. We purchase things from outside of our region all the time. If we happen to include those regions in our analysis, we're going to capture some of that spending. And the last one is going to be the workers. So we said in a single region analysis, we know that not all of our workers are going to live and reside and work in the same region. Some of them are going to live outside the region. If we have linked up those other regions through this MRIO process, we can capture the spending of their earned income on that region. So this graphic is going to look very similar to the one that we saw a couple of slides back, but here, instead of all those leakages on the right, we now see region B, our linked region in MRIO. And these can be any types of regions, right? We can say region A is going to be Texas and region B is going to be Oklahoma. If there is some change in production, a new business or an existing business in Texas, region A, we're going to model the economic effects of that business. That business is going to purchase some of their goods, though, from region B. So we can see the trade happening between those indirect purchases or those intermediate inputs from region B, Oklahoma. We know that some of the workers in our directly impacted industry and our indirectly impacted industry also live in Oklahoma, but they work in Texas. So now, because we've linked up Oklahoma or region B, we're going to capture the spending of those workers in Oklahoma. And then lastly, we can see the induced effect trade that happens when our households in Texas purchase goods that were produced in Oklahoma. You will see that there are still going to be leakages, right? We've only included 2 regions, but again, we live in the US. There are other states in the US where we could buy goods from. There are other countries in the world where we could buy goods from. So there's always going to be some type of leakage that occurs that you're never going to be able to capture. But MRIO does allow us to capture the impact here in region B, Oklahoma. because we've identified that as a region of interest. We want to see the economic effects there, in addition to the economic effects here. So in order to accomplish the MRIO analysis, we need data on trade flows. Those are those goods and services and the commuting pattern of workers on a county-to-county basis. The EC commuting rates that we get here at IMPLAN are going to be derived from the US Census Bureau's Journey to Work data, but the trade flows are actually created by IMPLAN's data team using a gravity model. So I am by no means an expert on gravity model estimations, but I will do my very best here to explain it. So our trade flows are going to be based on this gravity model. The gravity model is based on Newton's law of gravity, whereby the force between two masses is going to be a function of the size of the masses and the distance between them. The law states that the attraction between those two masses is directly related to the size and inverse related to the distance. In this case, the masses are going to be the places, the counties, and the force that we're going to have is the trade itself. The size or the mass of the region is also often going to be defined as the gross supply or gross demand of that region. The distance here is not just the physical distance, but rather the cost of moving goods and services between them. So it's based on the actual distance and the mode of transportation that is used to transport that specific commodity. All of these travel cost indices are provided by ORNL, or the Oak Ridge National Labs. So the three main databases that our data team uses to create these trade flows is going to be that we get from the Oak Ridge National Labs, the county-to-county distance by mode of transportation. We also use data from the Commodity Flow Survey, or the CFS, which gives us the tons of miles data by commodity. And then we use the IMPLAN commodity supply and demand by county, which is, again, produced from some other data that we have within our models. So the result of this gravity model is a trade flow on a county-to-county basis, the distribution of a commodity supply from its produced region to its purchased region. So just for a quick example here, let's just say that all of the grain produced in Waukesha County, Wisconsin, 10% of that grain is going to go to the demanders of grain in, say, Sheboygan County, Wisconsin, right? That is a data point that you would find from this trade flow estimation. This data is then used by IMPLAN to calculate the regional purchase coefficients, or RPC values, for each commodity in a region, or how much of the commodity that is demanded can be sourced from our local supply. This is very important in an MRIO analysis because we know if we can't get that product locally, we have to import it. And if it's going to be imported from somewhere, we need to know where. Is it a region that we've linked up in this analysis, right? If you'd like to learn more about the gravity model, how it works, etc., you can watch the YouTube video that our chief economist, Dr. Jenny Thorvaldsen, created, or you can read the white paper that is listed on our support site. Lastly, here we're going to talk about the journey to work data. So that gives us our commuter flows, our county-to-county commuter flows. This comes from the US Census Bureau. It's the journey to work data, which is from the American Community Survey. We use the 5-year estimates from that. So IMPLAN converts those journey to work flows, which are based on employment, and we apply that, we create a ratio from that and apply that to our post-payroll employment compensation values by region. So the commuter flows that we have are going to be regional, right? But it is not industry specific. So we don't have enough data on how one industry commutes versus another industry, the workers within that industry, I should say, but it's all regional. So each region will have its regional commuting rate. So if we can see this in action here a little bit, in a simple MRIO analysis, we can have one event in one region. In this example, we have 2 events in one region, but in reality, we could have multiple events in all 3 regions. And in fact, instead of 3 regions, we could have 10, 20, 50 regions. Each event in each region would create its own calculation of effects, or we refer to them as trees. Let's say that event 1 here that we have is a new hospital that's being built in region A. Some of the construction inputs, say cement, might be produced in our linked region B. In that case, from region A, dollars are going to be sent over to region B for that cement purchase. And then in region B, that cement producer might also need to source some of their products from regions A or regions B. When we're running an MRIO analysis, this is how it starts. It starts with our direct effects in each region. And we create trees to signify how those dollars continue to circulate and bounce around between the regions until each dollar trickles through our economy down to $100. Unfortunately, we do not go down to a penny as we do in our single region analysis, but we go down to $100. So $100 of traded commodity values from region to region. So the more events you have, the more regions you have, the longer and more complex these trees are going to be. Because as you see, purchases from region A go to region B and then to region A, and then from region A can go back to B, back to C. These can keep going. They become very complex. The percentage at which these flows of dollars are happening are going to be based on those two data points we just talked about. The regional purchasing coefficients, those trade flows, how much of this commodity am I purchasing from this region? And the commuter, how many of my workers live in this region but worked in that region? Okay. So just to have a little comparison between the two, single region versus multi-region analysis. In a single region analysis, we are limiting the backward supply linkages within our boundaries of this single study area. So in this case, we have the state of North Carolina. We're modeling an effect here in the state of North Carolina. We know that we're going to buy some goods from producers within our state. We know that some of our workers are going to live in the state, and we're going to model the effects from that. However, we know that we might have to source some of those goods and services from outside of the state of North Carolina. Some of the workers might live outside of the state of North Carolina. In a single region analysis, once those dollars leave, they never flow back in. Those dollars are gone, they are removed from the analysis. It's a leakage. In the multi-regional or MRIO, we're expanding those backward supply linkages beyond the borders of just that single region, but we've now included any linked regions. So in this example, we've linked up North Carolina to the state of South Carolina. So now if any of those purchases or any of those commuters happen to live in South Carolina, we are going to capture the effect of those spending and that production here in the state of North Carolina. Through this linkage, though, we might also have some returning back to the original state that we were looking at, North Carolina. In both instances, we're still going to have dollars that leak out. Production that happened in South Carolina, some of it might leak out to Georgia. Production that happened in North Carolina, some of that leaked out into, I think it's Virginia, that's above North Carolina. Right, so multi-regional input analysis just expands the region for you. When you run the analysis, however, your effects are going to be the cumulative effects on that region. Meaning, again, in this instance, the effect on our host region will always be greater than had we run this as a single region analysis because of those linkages back into this state. So one thing that people often get confused about is combined regions. In IMPLAN, you can create any combined region using state, county, MSAs, zip codes, CDs, so long as there is no overlap between those regions, or parent-child relationships as we like to call them. Meaning that you cannot combine Cook County, Illinois with the state of Illinois as it's already included in the state. However, once combined, the region is treated as a single region. So if you were to combine the states of North Carolina, South Carolina, and Georgia into one combined region, it is still going to be a single region analysis. It only becomes an MRIO analysis if you've linked each individual region up in the project, meaning you have a group for North Carolina, a group for South Carolina, and a group for Georgia. So at IMPLAN, we see all sorts of MRIO regions. I like to explain it like a jigsaw puzzle. Using IMPLAN, you can slice and dice the map into any regions you need for your analysis. However, once complete, the final picture of your jigsaw puzzle is the total effect, right? If your puzzle pieces were all of the 51 states in the US, then your final results are going to be the national impact. If you use 4 states, then your cumulative effect is going to be the total impact on those 4 states combined. Even if you ran them as a single region analysis, the difference is that through the MRIO, you have linked up to get the actual trade flows and commuting flows between them. So just a couple examples here of things that we see. So here we have a multi-regional or an MRIO analysis, but here we have 5 regions. Those 5 regions are combined regions within the state of Louisiana. So this is from the LSU Agricultural Center, but this can be the same for any other type of regions. I know FEMA has 10 regions in the US, right? However, you want to slice and dice up your map to create some new region. But in this case, we are looking at 5 regions. We've created a combined region for the Northeast, a combined region for the Northwest, one for the Central Louisiana, Southeast, and Southwest Louisiana. We also see multi-regional input-output analysis using 2 different types of regions or geographical levels. We can see one state here being used, which is Washington, D.C., and then it's linked up to Arlington County, Virginia. That's still an MRIO analysis. We're linked up 2 separate regions together. They don't have to be the same type of regions. State to state, county to county. You can do zip to another county. You can do state to another county, etc. But the most common thing that we see in MRIO analysis is going to be one to the rest of. A lot of times people are looking at an individual county or an individual state, but they want to see the impact on the rest of the state or the rest of the US. In this example, there's still 2 regions. Your host region, which is going to be the state of Texas here, and the rest of the US. That's a combined region that we created using every other state in the US. Remember, when you're setting up projects with larger study areas, they're typically going to have less leakages than smaller geographies, right? Your supply and your workforce is just greater. You've expanded that region. But these larger regions are also going to be weighted averages of smaller components. So you lose that regional specificity, those actual economic conditions that occurred when you select a state over a county or an MSA. This is also true when multiple regions are combined. The characteristics of that new aggregated region becomes the weighted average of all of the included pieces, which creates some type of aggregation-induced error or aggregation bias. Of course, a single region analysis is still valid. They're just missing part of the story, right? So just be aware of the bias when you're using those larger geographies, or if you're going to use that larger geography as a single region analysis. Lastly, when to use an MRIO. Essentially, anytime you want to see the effect of a local activity or policy on a larger region. Doing an MRIO will help you to improve the methodology of your study because you're going to maintain that regional specificity of the host region, and then just including in those larger areas. And that's exactly what I said, you're limiting the aggregation bias. It will allow you to also examine the interconnectedness of multiple regions, and of course, track those leakages that would have been from your original study region to see how it's affecting any of those linked regions that you have in your analysis. So some best practices for MRIO. In order to use the MRIO functionality, you will first need at least 2 regions, right? They can be 2 counties, 1 county in a combined region, or all of the remaining counties in a state. You cannot use an MRIO with a county and a state total if the county is part of that state, right? They have to be separate regions. Second, oh, sorry, I forgot to go through the bullets. Second, you are going to select your events in IMPLAN or regions in IMPLAN by building out them as combined regions, or just adding all of those selected regions to your project. Make sure when you're setting up your MRIO analysis that you apply the appropriate data dollar year combination. In the MRIO analysis, you are only allowed to use one data dollar year combination. It will not allow you to have dollar year 2025 and dollar year 2024 in the same analysis. If you are going to be doing a project where you need to look at an MRIO across time, across multiple years, you're going to have to set them up as separate projects in IMPLAN. So again, first identify your region, then you select your regions in IMPLAN. Lastly, you have to add events, right? There has to be some type of economic activity that occurs. You're going to add that to at least one group. You have to have one event and one group in order to run an MRIO. And then lastly, you have to check the MRIO box that is on your impacts page. You can set up 50 regions and 50 events, but if you do not click that MRIO box, you will not get effects from the events on the other linked regions. Before the advent of MRIO capabilities, there was an approximation method known as the mock MRIO. This was a process by which users would examine or analyze the same event in one region and in the larger corresponding region, meaning they would look at it in a county and then look at it in the corresponding state. There was no linking of regions that occurred in this process. The analyst then would interpret the difference between the two sets of results as spillover effects. So the effect on the county and then the spillover effects to the rest of the state. However, it wasn't a rest of state, it was just the state. This is not an acceptable method, so don't do it. As we know from our discussions already today, when you're using a larger region, you're going to have some level of aggregation bias, right? Because the multipliers that you're using, that IMPLAN is using at the state level, are going to be different from the multipliers that are used at that county level. They're not going to be the difference between the trade that occurred. It's going to be just a whole separate set of multipliers. This can result in dramatically under or overestimating of effects in either region. By doing this, you're losing all of the inter-regional commuting and trade flows, period. You're not using them at all. So if you want to do an analysis where you see the effects on a larger region, you have to do an MRIO study where you create the one county and then you create a rest of state region with all of the remaining counties in that state. So a couple notes here on the capabilities and limitations of MRIO and IMPLAN. MRIO is going to work fastest with up to 10 regions. We have successfully ran projects using a 51 state MRIO, but it takes a long period of time. Obviously, the more regions you have, the more events you have, the larger the number of dollars that you have in those events, that's going to all increase the time that it takes to run or process the analysis in IMPLAN. So I suggest aggregating regions when possible. If you're trying to do a 51 state MRIO, potentially breaking up the US into several different regions, or same as we saw in Louisiana, breaking up the state into several regions. You can only, again, use that one data dollar year combination. And all of the trade that happens in an MRIO analysis is going to stop at a threshold of $100 per commodity. Because of that, the MRIO analysis is not linear. In a single region analysis, if you increase output by 10%, the effects are going to be increased by 10% over your original. MRIO is not the same. Because it's based on all of those supply and demand coefficients, the RPCs, and all the commuting rates, it's never going to be linear. Few other considerations. I've already mentioned this as well, but remember, if you're running a single region analysis and then you run the same region but link it up to another region in an MRIO analysis, your host region is always going to have some greater indirect and induced effects based on those buybacks and linkages, between the regions. IMPLAN is already going to be accounting for commuting in a single region analysis and in your MRIO analysis. However, we know that a lot of people come to IMPLAN with very complex projects where they know exactly how many people are going to be living and commuting from this region to the host region. We do have some workarounds available to the user if you need to adjust your values to compensate for the commuting rate that IMPLAN is already applying to your analysis. IMPLAN MRIO is also going to allow you to have direct effects in multiple regions. MRIO is not just linked one region to the other to see the spillover effects. You can have events in region A and events in region B and see the combination of effects, the cumulative effects of all of those events in all of those regions. Just be careful when you're running these MRIO analyses, when you're using, let's say, a company that has a lot of vertically integrated companies. So one of their companies produces an input to one of their final products. Again, those are very complicated and complex studies. I just wanted to address it here to let everybody know if you are going to be running that type of analysis, make sure you're customizing your events using the IIA event specifically to accommodate for that purchase. Otherwise, if you were to just link it up and not compensate for it, you could be overestimating the total effect from that purchase. And lastly, interpreting results. So when you're doing an MRIO analysis, when you get to your summary page of your results, they are going to be the cumulative effects of all events and all regions. You're only going to have direct effects in the regions where you had events. To separate out the effects from the different events or from the different regions, you're going to have to use filters. So the first filter you always want to apply in this analysis is going to be your dollar year, right? Don't start exporting or downloading or copying over some results without first changing it to the appropriate dollar year that you want to report your results in. Once you set that, then you can slice and dice it however you would like. You can slice it by region, you can slice it by event, you can slice it by group, by impact type, that's the direct, indirect, and induced, or by an event tag. So just thinking about an MRIO analysis here, if we're thinking about slicing and dicing those results. And here we have an MRIO analysis using 3 regions, region A, B, and C, and we have 3 events. Event 1 and 2 happened in region A, and event 3 happened in region B. Region C had no events. But because we've linked it up in the analysis, we are still going to see some effects there. They're going to be the indirect and induced effects. Now, if we wanted to isolate out our results for region C, we would need to apply our region filter. In this case, our region filter would be applied for region C. Now, if we wanted to further isolate our results and just see the impact from that one event on region C, we would also have to apply an event filter. So event 1 on region C. As you can see from this chain or this tree of effects that we have from our MRIO calculations, there are effects on region C from event 2 and from event 3. But in this case, we are only isolating out the effects of event 1 on region C. So be careful when you're using your filters that you don't overestimate or double count any of your effects inadvertently. All right, so with that, we're going to jump into IMPLAN. We're going to take a look at a couple of these types of projects. So I have actually set up a couple projects in advance for us, so we can go ahead and take a peek at some of those. So I'm just going to pop over to my projects page. And we're going to look at one of the first projects. The first thing I want to show you is the project that I called Failed MRIO. So we're going to go ahead and pop into our impacts page here. and take a look. In this project, we set up one event for tree nut farming. We did an ICA, or an industry contribution analysis, set it to 100%, and we placed it in the group of California. In this project, I wanted to see the impact of not just the tree nut farming on California, but I wanted to see it on all of the Western US. So if I pop back over to my map, you will see that I have added each state as a separate region in my analysis. So I have 7 regions in my multi-regional input-output analysis, and I have one event. That one event took place in California. But I wanted to see the spillover effects from all of the trade and commuting that happened in Nevada, Oregon, Washington, Idaho, etc. The reason that this project failed is because we failed to check the MRIO box. I can add as many groups as I want here and as many events, but if I don't check that MRIO box, I'm not going to get any effects. So when we go over to our results page, we'll see when I use my region filter, the only region we have effects in is California. So if I wanted to turn this into an MRIO, I would just have to check that box and rerun it. So that's the first project I wanted to show you guys. The second project that we set up was using that region that we looked at earlier for the state of Louisiana. In that example, for that MRIO, we had 5 regions, each region representing a smaller region of the state of Louisiana. We had the Southwest, Southeast, Northwest, Northeast, and then Central. Taking a little while here. There we go. So here it is. In this project, I wanted to look at commercial fishing within the state of Louisiana. So as you can see, we broke up our state into several regions, and we added them all as individual regions. In order to run this analysis, the first step, remember, is going to be to create our regions. So to start this project, we started here in the list view. From here, we went down to the state of Louisiana, clicked on it, and we can see now all of the counties in the state of Louisiana. If we select multi-view or toggle to the multi-select view, I can now check different counties, and in this case, they're called parishes, to create a new combined region. So we built out these regions first, and then we added them into our analysis. In this project, we had 5 regions, and I only created one event. I wanted to look at commercial fishing, the industry contribution, which is industry 17, 100% of that industry, and all 5 regions. So as you can see, I drag and dropped this one event into each of the 5 regions. You can see that because each region has the number 1, and it shows the ICA event is present. Because we ran effects in every region, we would expect to see effects in every region, right? Direct effects in every region. However, when I use my region filter, we're going to notice that we're not going to have direct effects in every region. And that's because certain places like central Louisiana didn't actually have commercial fishing. Now, we still linked it up in our analysis because we wanted to see the effects of commercial farming in southwest Louisiana and how it had affected the region in central Louisiana. So here you can see we didn't have any direct effects, but we did have some indirect and induced effects from that commercial fishing that took place in other regions of the state. Now, if we wanted to figure out where these effects came from or originated from, we could use our event name filter to see. In this case, it's just commercial fishing, right? We only had one effect, one event. It's just the one to select. Instead, what we could do is we could also use our group filter. So we could select the group as well. And there's no results, which makes sense. So that's one way that you can slice and dice your project to get the specific result of a project. And I see that we are running out of time here, so I did want to go through one more if we can before we pause to let Michael finish out the presentation. Looks like IMPLAN's being a little shy today. But there was another multi-regional input-output analysis that we created using the DC area. So in this example, we looked at the publisher, a newspaper publisher. We looked at the effects of that publisher on DC, and then we linked it up to that Arlington, Virginia county group to see the effects from that. So in this case, again, we have one event in two regions that we've linked together, but they're two separate regions, DC and Arlington. So in this case, if we wanted to see, again, the effects of this one event on Arlington, even though it took place in DC, we can use our region filter to see the indirect and induced effects from the newspaper publisher in DC on Arlington. All right, so we are at time, so I will go ahead and pass it back to Michael if you want to finish out the presentation.
Awesome. Thank you so much, Angela, and great job. Again, remember everybody, I know we've had a few questions rolling through here during the presentation. Remember that you can post your questions into that GoToWebinar question box. We will be closing the presentation here shortly, so if you have follow-up questions, please send those to support@implan.com and we'd be happy to get back to you. If you want to dig a little deeper into the application and you're not a current IMPLAN customer, you can always schedule a live personal demonstration by visiting implan.com/demo. On a demo, our team can show you all of the data inside the application, run through an analysis specific to your interest, and show you all of the results populated by IMPLAN when you run an IMPLAN project. To schedule yours, visit implan.com/demo or email sales@implan.com. Also remember that you can always reach out to our customer success team at support@implan.com with a specific question. In addition to that, you can also post a question or discussion topic into our community forum located on support.implan.com, which we see here, which is an extremely valuable resource that provides 24/7 support resource assistance. Find recordings of past webinar sessions such as today, along with registration for upcoming webinar sessions under the Learning Center. And with that, again, thank you everybody for joining us. Thank you, Angela, for leading us through a very interesting presentation on MRIO, and we look forward to seeing you all again soon.
Thanks for joining, everyone.